Hello students and welcome to the lecture. So students, as we know that we are covering the important banking concept and terms, and in the previous lecture basically we have done with the part 1. In this lecture what we are going to do, we are going to see the part 2, or we could say that basically we are going to continue our journey that we had started in the previous lecture covering the banking concept and the terms. Like in the previous lecture, before even starting the lecture, I had told you that these are important for our examination because these are just not only the part of the statistic, but also if they are in the news, which they always been, so they could be asked in the current affairs too. And I hope you have revised the lecture in the well enough manner. You had taken that thing in a serious manner. So now let's see that what we are going to cover here. In this, we will first cover the important codes we used in the banking. Second, we will look upon the SWIFT code. Third, we will talk about the reverse mortgage loan. Fourth, the act's years to be remembered. Fifth, a brief on the balance sheet of the bank. Sixth, assets of the bank. Seventh, functions of commercial banks. Eighth, a brief on the inflation. Ninth, a brief on the qualitative measures used by the Reserve Bank of India to manage the money supply. Then the financial abbreviations, and at last, we will have the discussion over the summary of all the things that we would cover. So this is going to be another important lecture because this is the part 2 of important banking concept and terms. But before starting this lecture in actual form, we having a small disclaimer to be here to understand. So the disclaimer is like the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, then please contact us at sathee@iitk.ac.in and we shall remove the images. Okay. So now after understanding the disclaimer part also, let's begin with the topic. So the important codes we used in the banking. These codes are important not just only for the competitive exams, okay? Because we are not just only supposed to go and pass the examination. That's why we are learning the things here. But you can say that these codes even we use in our day-to-day lives. Like if you are adult, if you are above 18, then most of you will have their uh, bank accounts, right? So in bank accounts, many times when you do a transactions, so you require these code to be filled. And if you are not aware about these codes, then there are possibilities that you will make some mistakes while using these codes, and that could even having some negative impact on your economic lives as well. So now we can say it is important from the examination point of view. Also, it is important for our daily lives. Okay. So the first code that we are going to see is the IFSC, Indian Financial System Code. Like almost all of you have gone through it. The IFC, Indian Financial System Code. Mostly of all of us heard about this name. Okay. So what is Indian Financial System Code in actual? What do you mean by this? The Indian Financial System Code is actually an alpha-numeric code. Alpha means using the English alphabets. Numeric means even using the numbers. And it is a mixture of these two, alphanumeric, that uniquely identifies a bank branch which is participating in NEFT system. Now, what is NEFT system? The NEFT system stands out for National Electronic Fund Transfer. Okay. So if any bank using the NEFT for facilitating the transactions for the customers, then that bank must have its own IFSC code. We know the IFSC code is the alphanumeric code. So how many digits does it contains? So basically it is containing the 11 digits. That's why it is regarded as the 11 digit code. With the first four are alpha characters representing the bank. Like by seeing these first four alpha characters, you will be able to identify like which bank we are talking about. For example, here we have used it SBI. So here you can say SBI. So what bank you are identifying it as in State Bank of India. Okay. The fifth character is always zero like this. It is only for future use. And last six characters representing the bank branch, like which branch we are talking about. So you can say suppose if there are two friends, one is having the code in the XYZ bank, sorry, account in the XYZ bank, and the XYZ bank having the branch in Karol Bagh, New Delhi. Then another one is having the account in SBI and SBI having the branch in Marthahalli, Bangalore. Okay. So now we could say one friend who is having the account in XYZ, he is required to send the money to the another person who is having the account in SBI. But you can say both the XYZ and the SBI, they are having multiples of branches across the country. How it is to be identified that about which branch they having their account and to which branch the fund is to be transferred, and from where the fund is to be deducted from which branch and then transferred. Here the IFSC comes in. Like first, by seeing the four alpha numbers, you will be able to identify that this is talking about the XYZ bank. Zero is your future use, and this six digits will denote that basically we are talking about Karol Bagh branch of SYZ, XYZ. Okay. Similarly, for fund transfer, SBI is showing that the fund is to be transferred in the SBI bank, and this number will show that it is actually to be sent to the SBI bank's branch of Marthahalli, Bangalore. So that's how the IFSC works. Like here you can say it is another example of IFSC, and it is for PNB. PNB stands out for Punjab National Bank. Okay, like first four characters PNBN refers to the Punjab National Bank. Zero is actually the control number. Okay, and this that you are seeing here, last six digits stands out for 014976. That actually represents the PNB branch, which is on Khurshi Road in Lucknow. Got it? Now the miker. So whenever you have used the checks, okay, so all if you have ever seen the check, then you must have seen this kind of digits at the bottom of the checks, right? You must have seen these digits on the bottom of the text. So what do you mean by these digits? MICR, what do you mean by? It is actually stands out for magnetic ink character recognition. MICR, magnetic ink character recognition. Now, what is the significance of this? What do we understand by this? This is to be understand. So the MICR is actually the 9-digit numeric code. Numeric code, not alphanumeric code. Remember what I'm saying. Numeric code, not alphanumeric. Okay. Numeric means it only comprises the number. No alphabet is being used here. It is uniquely identifies a bank branch participating in the electronic clearing scheme. Like by reading these numbers, the fund transfer service provider could easily identify that which bank branch is actually being participated in this electronic clearing scheme. It is used to identify the location of a bank branch. Like again, we could say, suppose there are the two friends. One is having the account in XYZ bank. Another one is having the account in ABC. Both are national banks. Both having the branches across all over the country. How to identify which branch we specifically talking about? Okay. So suppose the person who is holding the account in the XYZ bank, he draws a check to another person who is having the account in ABC bank. Okay. But branches, what branches? From which branch the fund is to be deducted or debited, to which branch the fund is to be sent or credited. This could be identified through the MICR. Okay. Like Citibank branch 3. So it is usually used there. The MICR code is allotted to a bank branch printed on the MICR band of checks used for the electronic credit system. By entering these details, the bank branch and the account could be easily seen and the transaction could be facilitated. So in IFSC, alphanumeric code, okay, using the 11 digits, first four are the alpha digits to identify the bank branch. 0 is always common and another 6 numbers are used to denote the branch of the bank. In MICR, magnetic ink character recognition presented on checks, 9-digit numeric code, no alphabets used here, and it is actually used to locate the bank branch. Okay, now we have the Swift code. So if you are following the current affairs, then you must be aware about Swift code. Why? Because Swift code is always in the news, or we can say most of the times it remains in the news. Like if you remember when the Russia and Ukraine conflict started in the previous year, okay, during that time, basically, Swift imposed some sanctions on Russia so that the Russia should not be able to facilitate their international transactions. Okay, so what is Swift, how it works, and why it is important to use a Swift in order to facilitate the international transactions. So Swift, first we have to understand the full form. SWIFT stands out for the Society for Worldwide Interbank Financial Telecommunication. Society for Worldwide Interbank Financial Telecommunication. Okay. And India was the 74th nation which joins the SWIFT network. It is actually a network for interbank financial telecommunication through the mobiles and all on worldwide transaction. SWIFT code is actually the standard format for bank identifier code. Code use particularly in international transfer of money between banks. Like by seeing this code, you could easily able to identify that which bank we talking about, which country it is located, at which location, and what is the branch of that particular bank. Like SWIFT code consists 8 or 11 character. It depends. If the code is 8 digit, then it is referred to the primary office of the bank. Okay. Like 4 is actually for the bank code, 2 for country code in which the bank is situated. Again in 2 is a location code, at which location in that country the bank having its you can say office, and 3 is actually showing the branch code, optional. Like you can say, suppose if we're talking about the Citibank, so 4 will show the Citibank. Country, USA. Location, for example, we're talking about the you can say New York. All right. Branch code will show Washington. All right. That is the thing. Now we have the RML, or stands out for reverse mortgage loan. Now what is this? Reverse mortgage loan. So simply first we understand what you mean by the reverse mortgage, mortgage loan. So if you remember in the previous lecture when we were talking about the secured loans, so we have gone through the fact that secured loans are those loans which have been granted to the customer against some security which is being kept by the bank. Okay, like you can say, if the person has taken a loan of 6 lakhs, then he must be able to submit it something to the bank of worth 6 lakh. So if in future the customer faulted to pay the loan back to the bank, then the bank could sell out that particular mortgage security to recover the amount. Okay, so mortgage is usually used for the secured loans. Now, after understanding the mortgage, it's a time to understand the reverse mortgage loans. So the scheme of reverse mortgage has been introduced for the benefit of senior citizens who owing a house but having the inadequate income to meet their needs. Like you can say, if there is any senior citizen like Mr. X, for example, he is having the house, but he is not having a money to run his daily life. Then the person could do like a homeowner who is above 60 years of age eligible for reverse mortgage loan. It allows him to turn the equity in his home into one lump sum of periodic payments mutually agreed by the borrower and the banker. No repayment is required as long as the borrower lives. Borrower should pay all taxes relating to the house and maintain the property as his primary residence. Like, let me tell you in the layman terms. Mr. X, who was holding a house but not having a sufficient, you can say, income to run his home. So, suppose his house was worth 40 lakhs. He submitted his house to the bank. Okay. Then bank granted a loan to him. But that loan would not be granted in a full payment. These 40 lakhs will be given in some small periodic payments up to some periodic time as agreed by Mr. X and the bank. For example, 1 lakh per month. Okay. So till the amount 40 lakhs lasted, the bank will give 1 lakh to the Mr. X. Okay. And until Mr. X lives, the bank will not require repayment of the amount that has been sent to Mr. X. But when Mr. X dies, then his family having a choice to sell the house to the bank, or in order to recover the house they require to repay the amount the bank has paid to Mr. X. Okay, and it is on Mr. X to pay all the taxes which are relating to the house and maintain the house property as his primary residence. The amount of loan is based on the several factors. First, borrower's age. He must be 60 or above of it. Value of the property. As per the value of property, the amount that is to be given by the bank would be decided. Current interest rates. Like what is the current interest rate? So that could also be, you can say, included in the lump sum amount. The specific plan chosen. Like the time period the person choose for the reverse mortgage loan. So as per the scheme formulated by the National Housing Bank or NHB, the maximum period of the loan period is 15 years. It means for one time the person could only avail this only up to 15 years. Then the residual life of the property should be at least 20 years. Where the borrower lives longer than 15 years, periodic payments will be not made by the lender. However, the borrower can continue to occupy the property and not required to repay it. The repayment is only required when the borrower is not alive. But if he is alive and he lives more than 15 years, the bank is only entitled to pay him amount up to 15 years. The above years, above 15 years, how much years he will live, he will not entitled to receive any payment from the lender. But he is having the right to occupy the property until he dies. Now, let's have a look over the acts years to be remembered. First, Reserve Bank of India Act 1934, Government Securities Act 2006, Banking Regulation Act 1949, Foreign Exchange Management Act 1999, Securitization and Reconstruction of Financial Assets and Enforcement of Security Interests Act 2002, Payment and Settlement Systems Act 2007, Negotiable Instruments Act 1881, State Bank of India Act 1955, Companies Act passed for 2 times, 1986 and Companies Act 2013. Now, most of you will say the Company Act has also passed in recently year of 2019. So let me correct you. That was not actually a new act like Companies Act 1986 and Companies Act 2013. It is actually a slight modification, or we could call it as a uh, amendment which is made to the act. Okay. So now we having the Companies Act 2013 and amendment of Companies Act 2019. Got it? Then the State Bank of India Subsidiaries Bank Act 1959. Remember, this is different from the State Bank of India Act 1955. It is different from it. Okay. The State Bank of India 1955 was actually passed to convert the Imperial Bank of India into a nationalized bank under the name of State Bank of India. Whereas the State Bank of India Subsidiaries Bank Act 1959 was passed separately to convert the other state banks that were actually working as associate and merge them with the State Bank of India fully. Then we have Deposit Insurance and Credit Guarantee Corporation Act 1961. Okay. Banking Companies Acquisition and Transfer of Undertaking Act 1970. Regional Rural Banks Act 1976, also known as RRBs. Banking Companies Acquisition and Transfer of Undertakings Act 1980. National Bank for Agriculture and Rural Development Act 1981. National Housing Bank Act 1987. Indian Coinage Act 2011. And the Industrial Development Bank Transfer of Undertaking and Repeal Act 2003. Okay. Now, a brief on the balance sheet of the bank. First, the liabilities of the banks are authorized capital, the issued capital, subscribed capital, paid up capital, reserve fund, deposit borrowings from other banks, and bills payable. So these are the liabilities of the bank. The bank are obliged to follow. Now, what are the assets of the bank? This is important. The cash the bank holds, money at call and short notice, the bills discounted, the bills for collection, the investments, loans and advances, and the fixed assets. Now, what are the functions of the commercial banks? First is the primary function. Acceptance of deposits, advancing loans and advances, creation of credit, promote the uses of checks and remittance of funds. Acceptance of deposit, advancing loans and advances, creation of credit, promote the use of checks, remittance of funds. Secondary functions, collection and payment of credit instruments, purchase and sale of securities, collection of dividends on shares, and income tax consultancies. These are the secondary functions. Now, general utility functions, providing the locker facility, providing the credit card, providing a letter of credit, underwriting securities, accepting the bills of exchange, merchant banking, a brief on the inflation. Now, let's have a brief on the inflation. So, what do we mean by the inflation? First, inflation is the rise in the price of goods or services in an economy over a certain period of time. Like you can say, suppose if something was selling at rupees 100 and now it is selling at rupees 150. So 50 rupees is an increase in the price. So that will be an inflation. Got it? That will be an inflation. If we talk about the types of inflations, these are the wage inflation, price power inflation, cost push inflation, sectorial inflation, stagflation, mild inflation, hyperinflation. Now, what are the possible effects of inflation? First, it decreases the real value of money. Now we can say previously the 100 rupees note could buy you something, but now you required 150 rupees note to buy the same thing. It means the real value of money is decreasing. Second, it discourages the investment and savings. Like when the inflation will rises, so automatically the interest rates will be higher. Okay, sorry, the interest rate will be decreasing. So that's why the investment will not be lucrative. Secondly, the person has to erase his saving in order to meet the expenses. Then it leads to the shortage of goods, mitigate the economic recessions, reduce the level of debt. Now, a brief on the qualitative measures used by the RBI to manage the money supply. First, credit ceiling. In this operation, RBI issues the prior information or direction that loans to the commercial banks will be given up to the certain limit. In this case, commercial bank will be tight in advancing loans to the public. They will allocate loans to the limited sectors. Few examples of ceilings are agriculture sector advances and the private sector lending. Moral suasion. These are suggestions and guidelines by the Reserve Bank of India to the commercial banks to take so action and measures in so trend of the economy. RBI may request the commercial banks not to give loans for unprotected purpose, which does not add to the economic growth but increases the inflation in the country. Then, credit authorization scheme. This was introduced in November 1965 when P.C. Bhattacharya was the governor of Reserve Bank of India. Under this instrument of credit regulation, RBI, as per the guidelines, authorizes the bank to advance loans to the desired sector. Now let's have a look on the financial abbreviations. ACF, Auto Correlation Function, AD, Authorized Dealer, ADB, Asian Development Bank, ADR, American Depository Receipt, AFS, Annual Financial Statement, AGM, Annual General Meeting, AIR, CSC, All India Rural Credit Survey Committee, AO, Additive Outliers, AR, Auto Regression, ARIMA, Auto Regression Integrated Moving, Average, then AFS, available for sale. Association, Associated Chambers of Commerce and Industry of India, ATM, Aniscromic Transfer Mode, ATM, Automatic Teller Machine, BIS, Bank for International Settlement, BOI, Bank of India, BOP, Balance of Payment, BSES, Basel Committee on Banking Supervision, BSR, Basic Statistical Returns, C8, Capital Account Deficit, CAC, Controller and Auditor General, CBS, Consolidated Banking Statistics, CC, Cash Credit. Then CD, Certificate Deposit, CD ratios, certificate deposit ratio, CDBS, Committee of Direction of Banking Statistics, CF, Company Finance, CFRA, Combined Finance and Revenue Account, CJRA, Currency and Gold Elevation Account, CII, Confederation of Indian Industry, CO, Capital Outlay, CP, Commercial Paper, CPI, Consumer Price Index, CPI, IW, Consumer Price Index for Industrial Workers, CR, Capital Receipts. CRR, Capital to Risk Weighted Asset Ratio, CRR, Cashiers Ratio, CISIR, Council of Scientific Industrial Research, CSO, Central Static Organization, CVC, Central Vigilance Commission, DAP, Development Action Plan, DBOD, Department of Banking Operation Development, DBS, Department of Banking Supervision, DCB, Demand Collection and Balance, DCCB, District Control Cooperative Bank, DCM, Department of Currency Management, DD, Demand Draft. DDDS, Data Dissemination Standard, DEI, Department of External Investment and Operation, DSEX, Department of Statistical Analysis, Computer Services, DGBA, Department of Government and Bank Accounts, DGCINS, Directorate General of Commercial Intelligence Static, DI, Direct Investment, DGIGC, Deposit Insurance and Credit Guarantee Corporation of India, DID, Discharge of Internal Debt, DMA, DP Enterprise Ministry Account, DRI, Differential Rate of Interest Scheme, DSPB, Dissemination Standards Bulletin Board, DVP, Delivery versus Payment. ECB, External Commercial Borrowing, ECB, European Central Bank, ECGC, Export Credit and Guarantee Corporation, ECS, Electronic Clearing Scheme, EEA, Exchange Equalization Account, EEC, European Economic Community, EEFC, Exchange Owners Foreign Currency, EFR, Exchange Fluctuation Reserve, EPF, Employment Provident Fund, EUR, Euro, Exim, Import Export Bank of India, FCA, Foreign Currency Assets. FCB, Foreign Currency of Convertible Bond, FCNR, Foreign Currency Non-Resident Banks, FCNRA, Foreign Currency Non-Resident Account, FCNRD, Foreign Currency Non-Reputable Deposit, FDI, Foreign Direct Investment, FAMA, Foreign Exchange Management Act, FI, Financial Institution, FICCI, Federation of Indian Chambers of Commerce Industry, II, Foreign Institutional Investors, FIMDA, Fixed Income Money Market and Derivative Association of India, FISIM, Financial Intermediation Services, indirectly measured, FLAS, Foreign Liabilities and Assets Survey. FOF flow of funds, FPI for foreign portfolio investment, FRA forward treaty agreement, FRBM fiscal responsibility and management act 2003, FRN floating rate note, FSS Farmer Service Society, FWG first working group on money supply, GDP gross domestic product, GDR global depository reserve, GFT gross fiscal deficit, GFS government finance static, GIC general insurance corporation. Then GLS generalized least squares, GNI government not included elsewhere, GOI government of India, GDP gross primary deficit, GSEC government securities, HDFC housing development finance corporation, HFT held for trading, HICP harmonized index of consumer price, HU DCO housing and urban development corporation, IBRD International Bank for Reconstruction Development, IBS International Banking Statistics, ICAR Indian Council of Agriculture Research, ICICI Industrial Credit Investment Corporation of India, ICMR Indian Council of Medical Research, IDB Industrial Development Board, IDBI Industrial Development Bank of India, IDD Industrial Development Department, IFFD International Fund for Agriculture Development, IFC International Finance Corporation, IFCI Industrial Finance Corporation of India, IFR Investment Fluctuation Reserve Account, IFS International Financial Statistics, IGLS Alliterative Generalized Least Squares, IIBI Industrial Investment Bank of India. Thereafter, double IP Index of Industrial Production, double IP and INIP International Investment Quotient, IMD Indian Millennium Deposits, IMF International Monetary Fund, IRBI Industrial Reconstruction Bank of India, ISDA International Swaps and Derivative Association, ISIC International Standard Industrial Classification, ISO International Standards Organization, ITRS International Transaction Reporting System, IWGEDS International Working Group on External Debt Statistics, KYC Khadi and Village Industrial Corporation, LAF Liquidity Adjustment Facility. LAMPS Large Size Adivasi Multipurpose Society, LBD Land Development Board, LBS Locational Banking Statistics, LERMS Liberalized Exchange Rate Management System, LIC Life Insurance Corporation of India, LS Label Shift, LT Long Term, LTO Long Term Operation, M1 Narrow Money, MC Broad Money, MA Moving Average, MCA Ministry of Company Affairs, MIGA Multilateral Investment Guarantee Agency, MIS Management Information System, MMSC Minimum Means Squared Errors, MOF Ministry of Finance, MOF Master's Office File, MRM Monitoring and Review Mechanism, MSS Market Stabilization Scheme, MT Mail Transfer, MTM Mark to Market, NABARD National Bank for Agriculture Rural Development, NAC-LTO National Agriculture Credit Long Term Operation, NAS National Account Statistics, NASCOM National Association of Software and Services Companies. Then NBFC Non-Banking Financial Companies, non-banking companies, NBFC non-banking financial companies, NEC not elsewhere classified, at EENER nominal effective exchange rate, NFA non-foreign exchange rates, NFT net fiscal deficit, NGO non-government organization, NHP National Housing Bank, NIC National Industrial Classification, NIF note issuance facility, NMN net non-money monetary liabilities, NPA non-performing assets, NPD net primary deficit, NPRB net primary revenue balance, NPV net present value, NRE RA non-resident external rupee account, NR RA non-resident non-reputable rupee account, NRE non-resident external, NRG non-resident government, NRI non-resident Indian, NSC National Static Commission, NSSF National Small Savings Funds, OD Overdraft, ODA Official Development Assistance, OECD Organization for Economic Cooperation and Development, OECO Organization for Economic Cooperation, OFI Other Financial Institutions, Alters Online Tax Accounting System, OMO Open Market Operation, PACAF Partial Auto Correlation Function, PACS Primary Agriculture Credit Society, PCA RDB Primary Cooperative Agriculture and Rural Development Bank, PD Primary Deficit, PDI Primary Dealers Association of India, PDO Public Debt Office, PDO NDS Public Debt Office come negotiated. Then dealing system, PDS Primary Dealers, PF Provident Fund, PIO Persons of Indian Origin, PNB Punjab National Bank, PRB Primary Revenue Balance, PSC Public Sector Enterprise, PUC Paid Up Capital, QRR Quick Review Report, RBI Reserve Bank of India, RD Revenue Deficit, RDBMS Rational Database Management System, RE Revenue Expenditure, REC Rural Electrification Corporation, REER Real Effective Exchange Rate, RFC Resident Foreign Currency, RIB Resurgent India Bonds, RIDFE Rural Infrastructure Development Bond, RLA Recoveries of Loans and Advances, RLC Repayment of Loans to Center, RNBC Residency Non-Banking Companies, ROC Registrars of Companies, RPA Rupee Payment Area, RPCD Rural Planning and Credit Department, Reserve Bank of India, RR Revenue Receipt, RRB Regional Banks, RTP Reserve Transportation, RW Risk Weighted Assets, SAM, Social Accounting Metrics, SAS, Statistical Analysis System, SCARDIP, State Cooperative Agriculture Rural Development Bank, SCB, State Cooperative Bank, SCB, Scheduled Commercial Bank, SDDS, Special Data Dissemination Standards, STR, Special Drawing Rights, CB, Securities Exchange, and Board of India. SEBS, State Electrical Boards, SFC, State Financial Corporation, SGIC, Swarna Jayanti Gram Sarojaya Yojana, SHG, Special Help Group, Self-Help Group, SIDBI, Small Industries Development Bank of India, SIDC, State Industrial Development Corporation, then SJSRC, Swarna Jayanti Shahri Rozgar Yojana, SLR, Statutory Liquidity Ratio, SLRS, Scheme for Liberation and Rehabilitation of Scavengers, SMG, Standing Monitoring Group, SANA, System of National Accounts. Then SR, WTO, Small Rates and Water Transport Operators, SSI, Small Scale Industries, SSBEs, Small Scale Service and Business Enterprises, TB, Treasury Bills, UBB, Uniform Balance Book, UBD, Urban Banks Department, UCB, Urban Cooperative Bank, UCN, Uniform Code Number, UTI, Unit Trust of India, VC, Venture Capital, WPI, Wholesale Price Index, YTM, Yield to Maturity. So here we have finished the topic. Now its part was summary. We have seen the IFSC, MCIR, SWIFT code, then reverse mortgage, key features also, then key financial acts in India. These acts we have seen. Functions of commercial banks we have seen. Credit control tools we have seen. Abbreviation acronyms we have seen. So with this note, we have finished this topic. It is requested to all of you. Kindly revise the facts and figures that all we have discussed in this lecture and be ready for the next lecture. With this note, let's end this lecture and thank you.